Hello, this is Vince Edwards with Empire Builders, here to give you some more tips for my startups and entrepreneurs out there. As always, you can come join the Warrior Nation. We can take you to the next level. But today we're going to talk about the top 10 mistakes startups make when trying to raise capital. Let's just get going. First one, your pitch deck is unorganized, unclear, or too lengthy. When you start doing presentations to try to raise money, you want to make sure you have a really good presentation that's tight, concise, well-balanced, but it's in a good order and it's able to answer majority of a potential investor's questions. Pitch deck is pretty standard. I'll put a link down to a video that's gives a little more deeper on how to build a 13-slide pitch deck in 10 minutes. I think I mentioned that in my top tips to actually raise capital, but I also do that for this part too. But one of the biggest mistakes is people kind of throw a pitch deck together. Like I say, it's sloppy, it's unorganized. Investors get confused when you start pitching. And most of the situations you're going to run into trying to raise capital, you get one time to make that first impression and you don't get a second opportunity. So you definitely want to be on your A game and have this thing tight. Know the pitch deck inside and out, but make sure it's short, clear, concise, and it's not too lengthy. I've seen pitch decks, people show up to do a 10-minute presentation with a 40-slide pitch deck. It's not happening, guys. You can never get through all that. And people lose interest very quickly. We have short attention spans now anyway, ever since social media and text messaging, 140 characters. We're not going to hang around for 40 slides. It just doesn't happen unless you got me held captive. The second one is, this is a big one. You haven't done your research. Look, the one thing you've got when you're developing your new company, your startup, is time to learn, research, and understand your industry, your product, your service, the market, everything about it. That's one thing you have to be able to do is research, research, research. There's nothing more embarrassing to go pitch to an investor and you don't even know who your competition is, you don't know what the market size is, you don't know anything about the environment that you're about to introduce this product or service to. You have to do your research. Get articles, read up on it, see who your top competition is, see how you can differentiate yourself from your competition, understand how big the market is, understand how you play a role, how you're going to price your product or your service, how you're going to be able to get this to the masses or to whatever group you're looking to use it, and how you're going to be able to do that effectively. But that's all just about research. That's just putting in some good old elbow grease and getting those books out, getting on the internet and figuring out what's out there. So do your research, 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 research. And when you talk to an investor and they know more about everything than you do, literally, why would they want to invest in you? I mean, come on, you're supposed to be the expert at this, or you're supposed to be very knowledgeable, and you're supposed to be changing the world with your product or service. Please, do your research. The next one is you don't have a technical resource on your team. This is very, very important. The Valley is Silicon Valley, the Valley as we call it, has really cranked down on, especially the incubators and accelerators out there. They try to help entrepreneurs, especially some young entrepreneurs and people starting a new company, is to have a technical resource on your initial team. If you need a programming, or you're going to need an engineer or a designer, any technical resource to get your product to market, they need to be part of the initial team, whether they're an employee, whether they're part of the ownership team, whether they're a strategic partner that are signing on early on to do strict contractual work with you. But the one big thing, if they're not actually on the team, is investors are very leery about how you're going to get this to market at the right price point and be able to maintain and make adjustments. If you don't have that technical resource as part of your team, you're going to be relying on third-party resources through the whole process, which also can cause your idea or whatever you're doing to be stolen. It can also limit how soon and how quickly you can get to market. And the price will obviously cost you a lot more money if you're having to pay third-party resources to develop your product or service. Again, it's very important these days to have somebody on your team that can be that technical resource to actually make this thing come to life. Whatever the industry, whatever the product or service, you want that resource as part of the initial team. The fourth thing is projections, and that is if you're doing top-down projections versus bottom-up projections. I'll give a little bit on that, but there's going to be another video I'll put out more on projections and doing your pro forma. But how that works is, just give you a great example, top-down projections of this. There's 3 billion people in the United States. About half of them could use my product. If I'm able to sell half of those, that's 750 users. That's a lot of money. So I'm going to be able to put my projections. I'm able to sell 750 million users right off the bat. Oh, and wait till I get to China. Yeah, right. That's really going to happen. No, you got to start off with the market you're starting to market your service to, that single market, that single consumer, how that's going to spread, how that's going to go from consumer to more consumers, how that's going to go from market to market, how you're going to grow it both locally, regionally, nationally, internationally. But it has to start the bottom up, not from the top down. Yes, it would be great if I could just sell 1% of everybody in China because they like what I do. That's not going to happen. So make sure your projections are built from the bottom up, not from the top down. The next one is pitching the wrong people. This is an age-old problem with investors who think anybody that has money is a potential investor. That's a major thing from entrepreneurs, excuse me. They think any investor, anybody's got money can be an investor, and I can pitch anybody, any entity, and hopefully they'll like it and they'll put a bunch of money in. The problem you run into there is the fact of the matter is, do they invest in your industry? Do they invest at companies in your stage? Do they even invest at all? And what you get into do is you waste a lot of time, energy, and resources if you're pitching the wrong people. It takes money, even if it's just printing off your pitch deck, even if it's just travel money, even if it's just time you could be actually pitching the right person. It takes resources to be pitching these folks. If you're traveling, it gets very expensive. So you don't want to go to events or to go to pitch the wrong group and then find out they don't even invest in your industry or they don't even invest at your stage. You can do the research and find out who invests in what. Take an assassin's approach, not a shotgun approach. It costs a lot of money to start these raises and get through them. So always look to pitch to the right resources and try to make sure that you're not just wasting time and energy. Yes, it's great to get practice doing your pitch. It's great to let entities know that you may want to use later. But at the end of the day, you need to find someone who's willing to write a check now that's going to be able to help you now at your stage to get you to the next level. And you got limited resources. If you had unlimited resources, you wouldn't need an investor. Let's just be honest. So that's a big mistake a lot of entrepreneurs and startups make. Next is overly inflated valuations. The best example of this is if you ever watched the episode of Shark Tank, you'll see somebody come in there and they'll say, I'm seeking $1 million, I'm evaluating my company at $10 million, and I'm not even up and running yet. They usually just start laughing at them. That valuation is way out of line. That's a great example. But the bottom line is this, and I'll have another video about how to actually determine your valuation for startups and entrepreneurs. But the bottom line is it needs to be in line with where you're at, where you're going, and how you're going to build and get to the point where your valuation can be much better. That just fits right in with the next one, which is seeking too little or too much too soon. The big thing there is when you decide how much money you're looking to invest, remember, there can be multiple rounds of investment, but you need to make sure you get enough money at each stage to get you to a certain level. So what you really need to do is figure out how much money do I need to raise to take me to the next level of where I want to get my development so that money will get us to where we can go do this. Or this money's going to get us to where we can do this. And that's part of what you're going to use those resources for. That's your reasoning for raising the money. This is so that we can get in 2 more markets. This is so I can get my product to market. This will help us get through the beta, the testing of this particular item. That's how you got to think about it when you start looking at how much money to raise. And when you figure out what that number is, that's when you add maybe up to 20% buffer just in case. So you never want to raise too little. You want to raise a little bit more, but you don't want to go out of bounds either, because you can always do further raises down the line. The reason you also don't want to raise too much in the beginning is your valuation is going to be a lot lower. Once you get further in the process, the valuation should increase on your startup, which means you can give up less equity to get more money later. So it's very critical to kind of follow the structure of how companies raise capital so that you're not giving up too much too soon, but you're also getting enough money so you're not constantly raising, even though most startups will tell you when you get raising capital, sometimes you end up raising capital throughout the whole process. But you want to try to limit that so you can get through a raise, hit a milestone, raise more money if you need to, hit that milestone, and go from there. The next problem that startups run into is their inability or refusal to answer questions. This is huge. If you don't know the answer, tell them that you can get the answer or tell them why you don't have the answer. Always be truthful, but never just refuse to answer questions. Even if you have to tell them something you don't want to tell them, like, they actually picked the one scab that you got in your business plan, or this is the one subject that's kind of you're a little weak at. Come up with the right answer for that and how you're going to overcome that weakness or be able to deal with certain things. There's nothing more frustrating to a potential investor than to ask you a direct question and you do not give them a direct answer. I don't care. Make sure you answer the question the best of your ability and give them an answer. They're not there to play games. They're not there to dance around the maypole. They're there to get, in a short period of time, to understand your business, your model, figure out if they like the team, if they like the idea, and if you've done your research, they can get this to the next level. So they don't have time to play. Answer the question. Don't be afraid to answer the question. And believe me, investors understand that you're not perfect, and you might have made mistakes. You're going to make more mistakes. They want to know if you're coachable and that you've done the work and that you're willing to do the work. The next one is get investments, not commitments. This is a big one that a lot of people get caught up in is, when you're seeking investments, anybody that kind of tells you yes, you get real excited. But don't get caught up in just getting commitments. Unless you're raising capital and you need the entire raise to get started. Say you say, I'm building a facility. We're going to need $10 million to build a facility. In that case, it makes sense to say, I got to get the whole $10 million before I get started, because you're going to need the whole 10. So you can get commitments to say, when you raise this amount, I'll come in for this amount. I'll commit to this once all the money's in. But most raises, you want to do what's called a rolling close. And that is, get the money as you go. If you're doing an equity round, like a founder's round or a seed round, you should make sure you let them invest at that time, and that the round's not going to change the terms of that round. So you can go and collect that money and start moving to get stuff done to keep you moving. So if you don't fill out the round, you still have made progress, or if sometimes you oversubscribe. But the bottom line is, you want to go ahead on and be closing and getting capital in as soon as possible. You can do that whether it's equity, whether it's a convertible note, whether it's a safe. There's no problem doing what's called the rolling close. Rolling closes mean you may pay a little bit more on legal expenses just to get those closes done through you. But I don't mind paying a little legal expenses if it's putting cash in the bank. Get the cash in the bank. Commitments sometimes do not turn into cash. Some of those same commitments, if it takes you 6 months to do a whole raise, things may have changed in that potential investor's life cycle in that 6 months. He may say, I've decided I don't want to do that now. It doesn't seem like a good idea anymore. There you're back to the drawing board on that particular commitment. So get investments instead of commitments. And the last tip for mistakes that startup make, and I call this the curse of the founder, is don't be an asshole. This is about relationships. Nobody wants to invest money with people they don't like. Nobody wants to invest money with people they don't like. I don't care how good your product is, your service is. I don't care if it's life-changing, world-changing. This is about relationships. So they want to invest in a good idea, but they're investing in you, the founder, the CEO, the startup. They're investing in the team as well as the idea. Can that team bring it to fruition? And investors have money. You're asking them for money. They can invest in other businesses. They need to like you so they can want to take this ride, this roller coaster ride with you. This is like a marriage. You may be together 2 years, 5 years, 20 years. You don't know. So people want to get in business with people they like. Don't be an asshole. Be coachable, be workable, and understand you're trying to build a relationship. Again, if you got more questions, I'll be leaving a couple links down below. But come subscribe if you got more information. If you're a startup or entrepreneur, you definitely need to subscribe to Empire Builders, or you can call us at any time. We can always come try to see about getting you in our program and join the Warrior Nation. Take care. Have a good day.